If you're over 55 and not on Medicare yet, you can still add $1,000 tax-free to your HSA. I'm about to show you how to turn receipts into retirement cash, and no, I'm not talking about those CVS receipts that could double as a scarf. Welcome to 50 cents of advice, dropping dimes of wisdom, 1 50 cent at a time. I'm Eli Pennywise, and I'm here to cut through the financial BS that nobody else wants to tell you, especially when it comes to the stuff that actually matters for folks like us. Here's what we're covering today. First, that extra $1,000 the IRS lets you sneak into your HSA after 55. Then, the Shoebox strategy that's basically a legal cheat code for retirement. And finally, why your HSA might be better than your 401k. Yeah, I said it. Stick around because that last part, game changer. Alright, let's talk about the most underrated account in America, the health savings account. And if you're 55 or older and not on Medicare yet, you've got a golden ticket you might not even know about. The $1,000 catch-up contribution. Remember how in the 80s we had layaway? You'd put a little extra down to get what you wanted later. Well, the IRS is letting you do that with your health, except this time, Uncle Sam's giving you a tax break for it. In 2025, if you're 55 or older, you can contribute an extra $1,000 on top of the regular limits. That's $5,300 if you're flying solo, or $9,550 if you've got family coverage, and if your spouse is also 55 or older, they get their own $1,000 bonus, but they need their own HSA account. Can't double dip in the same pot. Now here's where it gets interesting. You've got this 10-year window between 55 and 65, before Medicare kicks in, to max out these catch-up contributions. Think of it like the last season of Cheers. You know it's ending, but you're gonna make every episode count. If you save that extra $1,000 every year for 10 years and earn just 5% annually, you're looking at over $13,000 in tax-free dollars by 65. That's enough to cover a lot of co-pays, prescriptions, or that knee replacement you've been putting off since your softball league days. Most retirement accounts give you two tax benefits. You either get a deduction going in but pay taxes coming out, or no deduction but tax-free growth. It's like choosing between Coke and Pepsi in the cola wars. You're picking your poison. But an HSA? It's like having the secret formula for both. You get the tax deduction when you contribute. Your money grows tax-free. And when you use it for medical expenses, no taxes on the way out. That's the triple crown. Like Secretariat. Except instead of horse racing, you're racing toward a comfortable retirement. Now we're getting to the secret sauce, and I'm calling this the receipt time machine because it's basically Back to the Future. Except instead of a DeLorean, you're using receipts, and instead of saving the space-time continuum, you're saving for retirement. Here's how it works. Let's say you have a $1,000 medical bill today. You could pay it with your HSA card right now. Or, and stay with me here, you could pay it out of pocket with your credit card, save that receipt, and let that $1,000 in your HSA keep growing. The IRS doesn't care when you reimburse yourself. Could be next month, could be next decade, could be 30 years from now. There's no expiration date on these receipts, as long as you had the HSA when the expense happened. So you're basically building a bank of receipts in a shoebox, or more realistically, in a folder on your phone because, let's be honest, who keeps actual shoeboxes anymore? Every copay, every prescription, every dentist visit, every pair of reading glasses, all of it qualifies. Years later, when you need cash for something, maybe your roof needs replacing, maybe you want to take that trip to see where the Golden Girls was filmed, you can pull out those old receipts and reimburse yourself. Tax-free. It's like finding money in your winter coat, except you actually planned it. Let's say you do this religiously for 15 years. You're paying out of pocket for everything you can. $1,500 a year in band-aids, prescriptions, doctor visits, whatever. That's $22,500 in receipts you're sitting on. Meanwhile, your HSA is maxed out and invested. It's growing, compounding, doing its thing like compound interest did in those savings bonds your grandparents bought you. Remember those? Then one day, you're 68, retired, and you decide you want to buy that boat you always talked about. You don't want to pull from your 401k and pay taxes. You don't want to mess with your IRA distribution strategy. So instead you submit 15 years of medical receipts and, boom, $22,500 appears in your checking account, tax-free, no penalties, no questions asked. It's like when Scotty from Star Trek said, "I'm giving her all she's got, Captain," except you actually gave yourself all you got, and it was legal. What you need to know right now. 3 things to remember. 1. If you're 55 or older and not on Medicare, start making that $1,000 catch-up contribution immediately. Even if you only do it for 5 years, that's meaningful money. 2. Pay for medical stuff out of pocket if you can afford to. Keep every single receipt, scan them, back them up, treat them like they're tickets to a Led Zeppelin reunion tour, because in retirement they kind of are. 3. Invest your HSA. Don't just let it sit there earning 0.01%. Most HSA providers let you invest in mutual funds once you hit a certain balance. Let that money work for you like it's trying to get a promotion at IBM in 1985. The Medicare Deadline you can't ignore. Here's the catch, and there's always a catch, isn't there? The moment you enroll in Medicare, you can't contribute to your HSA anymore. You can still use what's in there, but the contribution party is over.
So if you're approaching 65, you need to think strategically. Some people delay Medicare enrollment if they're still working with good insurance, just to keep maxing out that HSA. That's a personal choice that depends on your situation, but it's worth considering.
And if you've got a spouse who's younger than you, they can keep contributing to their own HSA even after you're on Medicare, as long as they've got their own account. Just like how you both had your own Walkmans back in the day, some things just work better separately.
So, here's your 50 cents. If you're 55 or older and not on Medicare, that extra $1,000 catch-up contribution is free money from Uncle Sam. Start the Shoebox strategy. Pay out of pocket, save receipts, let your HSA grow. This thing has triple tax advantages that make your 401k jealous. And remember, those receipts never expire. They're your golden ticket for later. You know how we used to look out for each other's kids in the neighborhood? This is that, but for retirement. Subscribe if you want me to keep watching the financial horizon for you. And seriously, share this with that friend who still thinks their 401k is fine. You know the one. They need this. Hit that like button if this made sense. Drop a comment and tell me. Are you already using an HSA, or is this news to you? I'm Eli Pennywise, and that's your 50 cents of advice. Keep the change.